Hi everyone. Before we move to the closing sections, let's do a quick vocabulary check because I want you walking away from this video able to hold your own in any investor or lender conversation. Pre-money and post-money, company value before versus after new investment is added. Dilution, the reduction in your ownership percentage from issuing new shares. WACC, weighted average cost of capital, the blended cost of a company's equity and debt combined. ARR, annual recurring revenue, your yearly run rate of subscription revenue. TAM, total addressable market, the total revenue opportunity for your product or service. IRR, internal rate of return, an investor's annualized return on their capital. Warrant, a lender's right to buy equity later at a fixed, usually last strong price. We covered this in depth earlier. Covenant, a condition in a loan agreement, like a minimum cash balance, that if breached, triggers default even if you're still paying on time. Runway, the number of months of operation you have left before cash reserves run out. And cap table, the ledger of who owns what percentage of your company across every round you've ever raised. These aren't just vocabulary. Every single one of these terms will show up in your actual term sheets. If any of these feel unfamiliar, I'd actually recommend pausing the video right now and rewatching the warrants and dilution sections, because everything else in this session builds on these definitions. Now let's bring this home to India specifically, because the venture debt ecosystem here has matured enormously over the last decade. And if you're building here, you should know these names. Venture debt activity in India grew about 12% in 2025 compared to the year before. That's a real signal that founders and lenders on the ground are both getting more comfortable with this instrument. Trifecta Capital launched India's first dedicated venture debt fund back in 2015 and has since deployed roughly 7,200 crores. That's over $860 million across more than 180 startups. Altiria Capital, founded in 2017, now manages assets under management of around 4,500 crores, close to $540 million, and has been backed by serious global institutional investors, including the IFC. Stride Ventures was actually India's most active venture debt investor in 2025, with 121 deals, more active than many traditional equity VCs in the country that year, which tells you something about how mainstream this instrument has become. And Innovent Capital, which started life as Silicon Valley Bank's India business before being acquired and rebranded, has disbursed over $900 million across India, China, and Southeast Asia. There are other strong players too: Black Soil Capital, GetVantage, Velocity, and others worth researching depending on your sector and stage. My advice: don't wait until you desperately need debt to start these relationships. Meet a couple of these funds early, even before you need capital, so when the right moment comes, you're not starting from zero.